Right now, at this exact moment, millions of people are looking at the same number. Silver, 75 when our 70s EVOs may be ADU an ounce. They refresh it, they watch it tick up, they watch it drop, and they think they understand what's happening. But here's the truth, that number is not the signal, it's the distraction. Because while everyone is staring at the price on their screen, something far more important is happening behind the scenes. Warehouses are quietly draining. Physical supply is tightening, and the institutions that actually move markets are watching something completely different. Not the price, not the chart. One signal, one metric. And once you see it, you'll never look at silver the same way again. Before we go deeper, quick note, if you're someone who wants to understand markets beyond headlines, beyond hype, and actually see what drives price in the real world, you're in the right place. This channel is built for that. Because we don't chase price here, we chase structure. Now let's start with something simple. Every single day, investors do the same thing. They wake up, they grab their phone, they check silver, and based on that number, they make decisions. Big ones. They buy when it spikes. They sell when it drops. They feel confident when it's green. And they feel nervous when it's red. And the entire time, they don't realize that the number they're reacting to is not telling them the real story. Because the silver price you see is not a pure reflection of supply and demand. It's heavily influenced by something else. The paper market. Let me explain this clearly. When you see silver trading at 72 per ounce, that price is not just coming from physical silver being bought and sold. It's coming from futures contracts, derivatives, algorithmic trading systems, short-term speculation. In fact, the paper silver market is many times larger than the physical silver market. That means price can move without anything changing in the real world. Think about that for a second. Silver can drop 3 Dow in a single day, and nothing meaningful has changed in mining output, industrial demand, physical supply. It's just paper being traded. This is where most people get trapped. They assume price moves till reality changes, but most of the time, price moves till positioning changes. Let me give you a simple analogy. Imagine there's a massive factory. Inside that factory, something critical is happening. Production is tight. Inventory is shrinking. Demand is rising every single week. Now outside that factory, there's a giant digital billboard, and on that billboard, a number flashes constantly. Up, down, up, down. That number reacts to headlines, rumors, interest rate expectations, currency movements, but not necessarily what's happening inside the factory. Now ask yourself which one tells the real story, the billboard or the inventory inside the factory. Most investors are watching the billboard. The serious money is watching the inventory. And right now, in the silver market, the inventory is telling a very different story than the price, because silver is not just another commodity. It's something much more complex. Silver has two identities, and this is where things get interesting. On one side, silver is a monetary metal. It's been used as money for thousands of years. It's held by investors as a hedge. It moves with inflation expectations, interest rates, and currency trends. But on the other side, silver is an industrial metal, and the modern world depends on it. Every solar panel, every electric vehicle, every advanced electronic system, every high-performance circuit, they all require silver, not as an option, as a necessity. And here's the key point, there is no easy substitute at scale. That means demand for silver is not just financial, it's structural. Let's look at some real-world context. Over the last few years, solar demand for silver has surged significantly, the EV production has increased globally, AI infrastructure and data centers are expanding rapidly, and all of these sectors consume silver permanently. Once silver is used in a solar panel, it's not coming back into the market anytime soon. This is not like gold. Where most of what's ever mined still exists, silver gets consumed. Now combine that with supply. Silver mining is not something that can just ramp up overnight. It takes years to bring new supply online, and most silver isn't even mined directly. It's a byproduct of other metals like copper and zinc, so supply is slow. Demand is accelerating, and yet the price doesn't reflect that clearly. Why? Because the price you see is dominated by paper trading, which brings us to the real signal, the thing institutions actually watch. It's not the price. It's not the chart. It's what's happening inside the vaults. Specifically warehouse inventories. Now this is where we go deeper, because this is the part almost nobody explains properly. Inside major exchanges like COMEX, silver is stored in vaults, and that silver is categorized in two ways: registered and eligible. Registered silver is available for delivery. It's the metal backing futures contracts. Eligible silver is stored in the vault, but it's not for sale. It belongs to private owners. So when someone demands physical delivery, it comes from registered silver. Now here's the critical part. When registered silver declines, that's not just a statistic, that's a warning. It means the cushion between paper promises and real physical metal is getting thinner. And when that cushion gets too thin, the entire system starts to change. Now look at what's happening right now. Over recent months, registered silver inventories have been under pressure. Metal is leaving the system. not in a dramatic, headline-grabbing way, but steadily, quietly, consistently. And this is happening at the same time as industrial demand is rising, supply growth is limited, global uncertainty is increasing. That combination matters a lot, because every ounce that leaves those vaults is one less ounce available to back the paper market. And if that trend continues, at some point, the market has to reconcile that gap. This is not speculation. This is math. If there are more claims on silver than there is actual silver available, something has to adjust. And historically, that adjustment happens through price, but not gradually, violently. Because when the physical market tightens enough, the paper market loses control of price discovery. And that's when the billboard suddenly catches up to the factory. And now here's the part most people miss. These shifts don't happen when everyone is watching. They happen when nobody is paying attention. They happen during sideways markets, boring price action, low excitement. They happen when retail investors lose interest. And right now, that's exactly the environment we're in. Silver is not making headlines every day. It's not the hottest trade. It's not trending on social media, which is exactly why the signal matters more than ever. Because while attention is elsewhere, the structure is changing. And the people who understand that are not reacting to price. They're watching inventory, they're watching flows, they're watching the system itself, not the noise on the screen. Because at the end of the day, price is just the output. The real story is happening underneath, and in the next part, we're going to go deeper into that. We'll break down the structural silver deficit, the real supply vs demand imbalance, and why this signal could lead to a major repricing event. Because once you connect all of this together, you start to see something very few people are seeing right now. This isn't about a short-term move. This is about a structural shift, and it's already in motion. And now you know exactly where to look. Because what happens next in this story doesn't begin with a headline. It doesn't begin with a breakout candle on your chart, and it definitely doesn't begin with a sudden spike in the spot price. It begins quietly, almost invisibly, inside a system that most people never even think about. Let me take you deeper. Right now, as you're watching this, silver is trading somewhere in the range of roughly 80 to 82 per ounce in the real-world market cycle over the past year. It has bounced, pulled back, rallied, and corrected just like any other commodity. But here's the part that should make you stop and think. Back in 2020, silver was trading near 12 during the liquidity panic. By 2021, it surged to nearly 30. Then it spent years chopping sideways, frustrating investors, shaking out weak hands, creating the illusion that nothing meaningful was happening. And yet underneath that sideways movement, the real signal has been building. Because during that same period, global demand didn't stall, it accelerated. Industrial consumption of silver has reached record levels in recent years, especially driven by solar demand, which alone now consumes a massive portion of annual supply. At the same time, mine production has struggled to keep pace, with multiple reports from the Silver Institute highlighting consecutive supply deficits. So while price appears stuck, the foundation is tightening. And this is where the next phase of the story begins. Because markets don't reward people who react to price. They reward people who understand structure. Now, let's talk about something even more important than warehouse inventories: positioning. Not retail positioning. Not what small traders are doing on apps. But institutional positioning, the kind of flows that actually move markets. Here's the reality. Large institutions don't buy based on hype. They don't chase green candles. And they definitely don't react emotionally to short-term volatility. They position based on asymmetry. They look for moments where the downside is limited, but the upside is massive. Where the crowd is disinterested, but the fundamentals are strengthening. Where the narrative is quiet, but the data is screaming. That is exactly the kind of environment silver is sitting in right now. And if you want proof of that, look at how the market behaves during stress. Every time there's a geopolitical spike, a currency scare, or a sudden shift in rate expectations, silver reacts violently upward. Not gradually, not politely. Violently, because the system is already tight. The only thing missing is the trigger. Now here's where things get even more interesting. Because the trigger for silver's next major move is not going to come from silver itself. It's going to come from the monetary system, specifically from real interest rates. Let me explain this in the simplest way possible. Gold and silver don't compete with stocks. They don't compete with real estate. They compete with one thing: yield. When you can earn a strong real return holding cash or bonds, metals tend to struggle. But when real returns turn negative, when inflation eats away at purchasing power, metals become incredibly attractive. And right now, we are in one of the most unstable real rate environments in decades. The Federal Reserve is caught in a trap. If they keep rates high, they risk breaking the economy. If they cut rates, they risk reigniting inflation. Either path creates uncertainty, and uncertainty is fuel for metals. Now combine that with what we discussed earlier, the structural silver deficits, a draining physical inventories, exploding industrial demand, a weakening confidence in fiat currencies, and suddenly you're not looking at a normal commodity cycle anymore. You're looking at a pressure build, a compression, a coiled spring. This is the part of the cycle where nothing seems to happen until everything happens at once. Now let's talk about timing, because this is where most people get it wrong. People want precision. They want to know the exact day, the exact price, the exact moment the breakout begins. But markets don't work that way. What you get instead is a window, a period of time where the probability of a major move increases dramatically. And based on everything we've just walked through, we are inside that window right now. Not before it, not approaching it, inside it. That doesn't mean price explodes tomorrow, but it does mean the conditions for an explosive move are already in place. And here's the key insight most people miss. By the time the move becomes obvious on the chart, it's already well underway. Because when silver moves, it doesn't ease into it. It accelerates. Think back to previous cycles. In 2010-2011, silver went from around $18 to nearly $50 in less than a year. That wasn't a slow grind. That was a surge, a repricing. A moment where the market suddenly realized the fundamentals it had been ignoring. And here's the uncomfortable truth. Most people missed it. Not because the data wasn't available. Not because the signal didn't exist. But because they were watching the wrong number. They were watching the billboard, not the factory. Now ask yourself a simple question. If the same setup were forming again, would it look obvious? Or would it look exactly like it does right now, confusing sideways, uncertain, easy to ignore? That's the nature of these opportunities. They don't feel like opportunities when they're happening. They feel like boredom. They feel like frustration. They feel like nothing is going on. Until suddenly, everything changes. Now before we close, let's bring this all together into something actionable. Not in the sense of telling you what to buy, but in the sense of giving you clarity. Here's the real takeaway from this entire breakdown. The silver market is not being driven by what you see on your screen. It's being driven by what's happening underneath it. The true signal is not price. It's the inventory trends inside exchange vaults, the gap between paper contracts and physical supply, industrial demand growth across multiple sectors, monetary instability and real rate pressure, and the behavior of institutions quietly positioning ahead of the move. When all of those align, price eventually follows. Not slowly, not gently, but decisively. And when it does, the window closes. That's how every major commodity cycle has worked. That's how every structural revaluation unfolds. Now, quick question for you. How many of you were watching silver back when it was sitting quietly around on 50 before it doubled? How many of you were paying attention before the last big move? Drop a comment below. I genuinely want to know. And if this breakdown changed the way you look at markets, even slightly, make sure you hit that like button and subscribe. Because this channel isn't about chasing price. It's about understanding what moves price before it happens. Final thought. There are moments in markets where the noise gets louder, but the signal gets clearer. This is one of those moments. The world is changing. The monetary system is under pressure, and the demand for real, physical assets is rising in ways that most people still don't fully appreciate. Silver sits right at the center of that shift. Not just as a metal, but as a signal. A signal that something bigger is building. And now, you know exactly where to look.